The Federal Reserve expects gross domestic product to grow quickly in 2026, faster than what they thought just months ago.
Some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now.
We have had a boost in productivity growth. And he was pointing out that that boost in productivity had occurred even before AI was a big thing on the scene.
Economists believe AI could dramatically change how Americans work.
In terms of policymakers' concerns, employment loss is huge, but productivity gains equivalently huge.
So the chairman is taking that into account and said, hey, we've had higher productivity. Now I'm looking at the idea that there's massive investment into AI, and I can probably expect some productivity or gains in efficiency from that. So that's, I think, part of what the Fed is thinking about right now.
Here's how AI is changing the Fed's economic outlook. New technologies tend to lead to employment losses, particularly during the early years of adoption. But eventually, they boost productivity.
In the very long run, suppose AI capacity can no longer expand, employment loss will be like 23%. But labor productivity can increase by 3 to 4 times. This is because AI can learn. And the human being can also try to utilize AI more effectively and train AI more effectively to suit each person. And thus productivity gain is actually huge.
Economists illustrate this with a J-curve.
When you introduce a new technology, in general, you have a decline in efficiency and even in job growth. And then the data starts to show an improvement in both productivity and in job growth. And I think the Fed is seeing, at least initially, that AI will probably be flat when it comes to job growth, as are most technological introductions, that you don't get a whole lot of jobs on the front end. When people start to incorporate and see places where that productivity has led to more profitability, that's when it leads to more job growth.
Today's labor market is growing at a relatively slow pace.
What we see is that job growth has definitely taken a step down, and that's been something that's progressed throughout the year. And part of that reflects layoffs of federal workers, but also we're seeing declines in the private sector as well. So it's not just federal government layoffs, but there's definitely been a step down in job growth this year. And it looks like it accelerated since the reciprocal tariffs were put in place in April.
The unemployment rate ticked up to 4.6% in November. The Fed's top economists say they can't tell how many jobs the U.S. needs to create to keep that rate from rising.
As we look at an environment that's been characterized, I would say, as this low hiring, low firing,
right,
it's worth remembering that's not what the business cycle looks like. You have low hiring, high layoffs, or you have low layoffs, high hiring. For both to be low at the same time, to me, that says more like uncertainty than it does slowdown.
The Fed's tools are not designed to address technological advancements like artificial intelligence.
What the Fed is looking for is what is the sort of cyclical trend versus the secular trend. What are things that it can do something about?
Generative tools like Anthropic's Claude, Alphabet's Gemini, or OpenAI's ChatGPT improve over time as more people use them to augment their work. As businesses adapt, economists say there's a chance that workers become significantly more productive, but lose leverage when it comes to wage negotiations.
Those people who can actually make AI better, who can also make themselves better, will never be replaced. The kind of middle type people may be capped. That will turn out to be a concern for sure, because we will end up with either lower employment or lower wage.
This moment has some parallels to the past. Investors have poured money into AI infrastructure, pushing price-to-earnings ratios for tech stocks up sharply, much like the late 1990s.
How do we know when irrational exuberance has unduly escalated asset values? And how do we factor that assessment into monetary policy?
Alan Greenspan saw the investment in technologies in the mid-90s. And he decided that it was accelerating growth because it was an investment in technology that he believed was going to create productivity. And what he did in the mid-90s was decide not to raise interest rates in the face of that acceleration in growth and elevated inflation. And that was a very, very good call. It was a good call for a lot of years.
The Greenspan Fed did lower interest rates amid a brief recession sparked by the burst of the dot-com bubble. Today, the federal funds rate is expected to hover in neutral territory. That means it's neither speeding up growth or slowing it down.
Greenspan came along with a theory that I think most central bankers have still adopted, which is this. The Fed should not pop bubbles. The Fed should be prepared to address their implications for the broader economy and the banking system after they pop.
AI's problem is the potential of driving down wage, the potential of driving down employment. Lower interest rate may not fix those problems easily.
I tend to think that AI will not behave like a normal technology in that it will kill some jobs and create other jobs and sometimes many more jobs. But I still think that AI is not the disaster for the labor market that many people are afraid of.